So within chapter 11, okay, if you their salvage value, or if we just depreciate them down to as much as possible to expand to the end of their useful life, what do we do with the fixed assets after that? Well, we can choose to dispose them. Now, what does disposing an asset look like? Well, if for any reason during or in the middle of, or you want to sell your fixed assets, that's how you can dispose it. You can either just get rid of it in general, or you can exchange it or replace the actual assets. Okay, that's a way that you can dispose a fixed asset. Okay. Now, what how do you dispose it? How do you write it off your books? Well, in this case, right, when you sell it, for example, you need to calculate or have the calculated amount, because when we do sell our fixed assets, especially when it's being a used asset, we either gonna have either or, right? We make gain money out of it, or we're going to be taking a loss. Now, if we actually get a gain, what does that mean? Well, it means that when we sell our fixed asset, we actually profited money compared to the book value. And if it's more than the book value of the fixed asset, then it's a gain. But if it's less than book value, then we have to continue with and report a loss. Now, in this case, most cases, when you are trying to get rid of your assets, you are more likely to take losses than get gains out of this kind of thing. Just because, again, it's already the notion that when you buy a fixed asset and you used it, there's going to be problems or situations are going to happen that whoever's going to be the next person that buys it, they may have to do some additional fixtures, or they might have to replace it. They might have to do some maintenance on it. So at the end of the day, you will be actually more likely losing a lot of value in an asset than where you're more likely getting a gain. All right, but that's just if you're trying to sell and dispose your asset properly. Okay. So again, let's go ahead and talk about the check marks that we need to make sure that we have, okay? First thing is, before, if you do plan on to selling your fixed asset, you need to have, number one is, what was the original purchase price that you purchased the fixed asset as? So we call that historical cost, right? The day that we purchased our asset is going to be the amount of asset cost. Now, that also includes everything that it took for you to get it ready for service. So that's going to be included as well. So make sure when you get the actual cost of the fixed asset, it is everything that you did, including maintenance fees, installation fees, sales tax, everything is going to be included, okay? And of course, you need to have you have to have the amount that you actually depreciated for. So depending when you do your depreciation, how long have you used it for? How much how much did you depreciate it over its life? And ultimately, because when you do depreciate it, you end up calculating the book value. Okay, you end up getting a book value at the end of a given month, again of at the end of a given year. So that's going to be the most important thing, because that's going to tell you how much the asset is worth. But you also have to look at who's going to be willing to buy it for that price as well. Okay? And then, of course, you're going to receive payments from the other person, and then you're going to record whether you got a gain or whether you recorded a loss. Okay? So in this case, you would typically credit a gain, and you would typically debit a loss, right? A loss is going to be considered an expense. A gain is going to be considered a revenue. Okay? And again, last but not least, you got to remove it off your books. So let's go ahead and take a look at our first example here. Example number 1, let's say on January 5th, you decide to purchase a machine for $50,000 on a credit card. So again, this includes, assume that it includes all fees, taxes, and whatnot is included into the price, okay? So let's go ahead and record the acquiring of the fixed asset. So in this case, right, date, right, we know that it's a fixed asset. It's going to be an equipment. In this case, I specifically say this is a equipment for machine. It's a machine. And because I paid with a credit card, that means I own this 100%, right? Because then I just owe money to the credit card company. So I record it in my books as is at $50,000. Okay? Then as you go through the rest of the years continuing on with this machine, you're going to keep tabs on to how to depreciate it. In this case, I'm going to depreciate it every single month. So I'm going to be using straight line just to keep it sweet and simple to depreciate for the first month. So in this case, my asset cost is $50,000. I've already estimated that at least the machine should have a salvage value of $5,000. And of course, I'm also going to, the estimated useful life is going to be 5 years. And the date that I placed in service is January 5th, right? Because I purchased it that month. So in this case, the first month's going to be as of January 31st. So I'm just going to do exactly how I've been doing. Solve for the basis, solve for the rate, solve for the depreciation expense for that month, and figure out what the book value is going to be. So in this case, right, my basis is going to be asset cost minus salvage value, which gives me $45,000. 1 over its estimated useful life, because it's straight line. 1 over 5 gives me 20%. And then, of course, for that month, I need to figure out that exact number. So what I'm going to do is I'm going to take my basis times my rate and divide it by the total number of months, which is 12, to give me a depreciation expense of $750. So that means for the month of January, all right, I'm going to depreciate it, right? Because I started in January 5th, that means I must depreciate it for the month of January. So therefore, I've depreciated for $750, which brought my asset book value to be $49,250. Okay. Now, and then of course you're gonna journalize it. So then every month you record it and you report it. So then when you do adjust your books, or when you adjust the asset and put it as its fair market value or its book value, we call it here, then it will reflect in your balance sheet and so on and so forth. Okay. So again, I'm going to go ahead and put depreciation expense and accumulated depreciation for the machine for the $750 as of January 31st. Okay. Now, fast forward, let's say 4 years later, you decide that you want to sell your old machine so you can get money to go buy a new machine, okay? And here on January 28th, you sold your machine for $10,000 cash, okay? So record this, the sale of the fixed asset and determine whether you had a gain or a loss. Now, in this case, how am I going to journalize it? Well, first things first is we need to figure out what my book value is right now, because that is important, because I need to determine what is the value of my asset. In this case, since I am selling it as of January 28th, right? Fast forward for 4 years is going to be 48 months, right? But because I have to depreciate it for January again, that gives me an additional month. So I'm on month number 49. I'm going to go ahead and calculate how much I'm currently at. So right now I'm at $36,750 worth of accumulated depreciation. And what I have as my book value is that it is going to be valued at $13,250. So that is my potential book value, okay? We're going to talk about the difference between book value and fair market value, okay? in later on towards the end of this. In this case, at least I know my asset is worth 13,250, right? But in this case, I have to also make that executive decision. Do I deny the person that I'm selling it to because they're offering me only $10,000? So in that case, already right there, if I already know that, I already can predict that I will be getting a loss. But let's go ahead and properly journalize it first. So in this case, I know at least this fact here is I'm getting paid $10,000. Boom, right? I'm receiving $10,000. I need to recognize I'm going to get rid of my machine. Okay? How much was my machine at historical cost value or the day that you purchased it? What was its purchase price? I bought it for $50,000. Okay? Now, of course, I also need to figure out how much have I used so far. Because in this case, this is a used asset. It's not going to hold its value of $50,000 after it's been 4 years. No, it's going to 100% lose its value. You cannot expect to sell a used asset for the price that you purchased it for almost 4 years ago. So in this case, this is where we have to make our adjustments, and this is where we need to put in here. Well, this is according to my depreciation table, because I used straight line. I've used so far in the span of the 4 years that I've used $36,750 worth of the machine, right? And then this is where I have to do my math. I'm only getting $10,000 for my machine, and I've already used $36,750 worth of my machine. But my machine at the end of the day should equal a total of my $50,000. Now, of course, when I gave you that little notion here where at the end of the 49th month, my book value should have been $13,250. In this case, if I solve for either or, right, the difference between 13,250 and 10,000 is I automatically know I'm going to have to write my loss as of the 3,250. Or I can do simple math here where I do my debits match my total credits and I would get the same exact answer. But in this case, it's because the reason that on my books, my asset is worth more, but I'm selling it for less. And that's always going to be 100% be the most common thing, because again, if the buyer is going to look at your product and be like, you used about 75% of it, I'm not going to pay you more than 75%, or I'm not going to pay you more than 25% for this asset. I'm going to pay you less than that. So that's how a lot of negotiations when it comes to being the buyer and seller is that most cases, especially for a used item, whether it's a machine, a printer, anything that's being used, it would significantly drop its value almost in half immediately as soon as you use it. Okay, no one's going to buy it back for more than 50% of the price originally, okay? Unless otherwise you do any other additions to this, okay? Now, what do you mean by that? Okay, so this is this right here where if I sold it for $10,000. Now, what if in this case, scenario 2, I actually sold it for $15,000 instead of the $10,000, right? This is the same scenario, but different, okay? Where we're looking at, well, what if I actually sold it for $15,000 instead of $10,000, okay? So again, I would do the same thing, right? I'd go to my depreciation table, figure out what my book value is, and also determine what my numbers are. What's my accumulated depreciation, and what is my asset cost? In this case, you are receiving cash for $15,000. The amount that you use the machine for is going to be the $3,250. However, my asset cost was originally $50,000. However, because my book value was again 13,000 um 13,250, I'm being paid $15,000 for it. So in this case, we have a gain of 1,750. So that's how you're going to record it and report it, and this is how you're going to actually take it off your books too. You're getting rid of it, so you're going to credit your fixed asset, so then it's no longer on your books anymore. And of course, because accumulated depreciation is a contra account, you need to also get rid of that too, because that's what helps you determine what the book value and what it actually is worth after you've used the machine. Okay? So that is how you sell your asset and record a gain or a loss. Okay? Any questions here? No. Okay. Yes.
Teacher, on profit and gain and loss,
Okay.
there is a, you don't say profit, and you said loss as loss. Yeah, you understand me? It's like loss, like expense here. Gain like profit, but you don't say expense or profit.
So in this case, right, when you gain money here, right, it's not in a sense of profit, because in this case, right, where if you, in this case, this gain right here, you're technically not profiting off of it because you're not in the business of selling machines. Okay, so I guess I'm trying to find a way to kind of make sense out of it. When you talk about a gain, right, this is going to be other income. It's not from your actual main core of operations. You're not in the business of selling machines. So in this case, you're not making a profit off of this, right? But you are gaining money because what you originally purchased it for, and when you sell it back to somebody else, instead of being under, which you're taking a loss, right? In that case, loss is universal. There's no other way that you can have a word for loss, right? You lost money for selling an asset. In this case, that's the difference here, because it's not technically a profit because you're not in the business of selling machines. So I don't know if that makes any sense to you or if that clarifies for you. In this case, you would 100% refer this to as a gain more than a profit. Okay? Because if you're selling machines, right? You're buying them cheap and selling them at a higher price, that right there is considered a profit because you're costing and generating revenue off of the machines that you're selling. But in this case, this is a purchase of a fixed asset for operations of the business. This is already an incurred as an expense as is because you are using it in order to operate your business. Okay. Any other questions? Okay. Now, what can I do to increase the value? If I'm reached at the end of its life, right? And I can see that this machine can still keep going, or if I add improvements to a fixed asset to extend its life, how can I do so? So you can do that by restoring or replacing or just doing some improvements in here. Now, but what can that do? That could be any fixtures, replacing parts, even going far as just doing regular maintenance on the actual asset itself, okay? By keeping up and doing this, you are going to be recognizing expenses. Now, how do I capitalize on that expense. Okay, so there are ways that you can do this, because if we remember, the cost of the asset includes any type of installation, all right, any type of things, right? Those are going to be considered expenses that are going to go towards the actual asset itself. So in this case, right, any improvement will either increase the book value, or you actually have the option to increase the cost of the asset. Okay, so there are two ways that you can record this if you choose to fix your machine or replace some parts to continue having it operating in your business. So again, let's take a look at this another example here. Okay, so if on January 5th, once again, we purchase the machine for $50,000 on a credit card, all right, so same scenario when I'm purchasing, right? Assume that all fees and taxes are included into the price. So let's go ahead and record the purchase of the fixed asset. So once again, I'm going to record this in my book so I at least have it in my book, okay? Right there. Now again, if 4 years later we decide that instead of buying a new machine, we decide to actually replace the actual motor inside the machine that cost $10,000. So this is a fixture. I'm replacing the motor itself to make it so then the machine is almost like it's brand new, right? The only difference is it's an older outer shell, but the motor is brand spanking new. Okay? And this is going to cost me $10,000. Now, in this case, when putting and installing that brand new motor, it actually extended its life for 3 more years. Okay, and this happened as of January 28th. Okay, so in this case, if my current accumulated depreciation is right now 36,750, right? If I'm using the straight line method again to depreciate the asset, right? We saw this example from the previous one. It's now 4 years later, and it's now January 28th, right? It's been 49 months. So right now I've already racked up $36,750 worth of accumulated depreciation, which brought my book value to be $13,250. Now, let's take a look at this approach first to just record this transaction to increase my book value. Okay? So in this case, this is how I'm going to journalize it. I'm going to take that $10,000 fixture, and what I'm going to do is I'm going to decrease my accumulated depreciation for my machine. Okay? And by decreasing my accumulated depreciation for the machine, it's going to, in reverse, increase your book value. Okay? How so? All right, let's go back to my depreciation table. This is what I'm currently looking at, right? This is the most current depreciation, right? I'm on month number 49, okay? Right, it's already been four years, and this is my accumulated depreciation. If I know it right now, it's 36,750. If I journalize it that way, what I'm doing here is I am going to decrease the value of my accumulated depreciation by $10,000. So instead of recording it at 36,750, it's going to decrease it down to 26,750. All right. And of course, with chain reaction, right? If my accumulated depreciation is going to be 26,750, therefore, my book value also follows along and changes as well. Because the book value, right, in our formula is going to be your asset cost of $50,000 minus your accumulated depreciation of $26,750. Therefore, magically, my book value has also increased by $10,000. So now I'm at $23,000 $250. And what do I do from here? I continue just as normal with my depreciation, because in this case, right, the only difference here is I reverted some time and added back the $10,000, but I still depreciate just regularly. Okay? Okay? Because in this case, I didn't increase my asset cost. So at the end of the day, my asset cost is still $50,000. So that's the huge difference here. My asset cost is still $50,000. It's still salvage value at $5,000. Now the estimated useful life, instead of since I only have a year left and I've increased it by another 3, then I just go ahead and continue depreciating just as usual. Right? So I'm going to depreciate, I'm going to continue. So the next following month, I'm going to depreciate it for my 50th month. Same depreciation method, same depreciation basis, the same rate, same amount of expense for the month. But this time, I'm calculating the accumulated and the book value to start from the $26,750, which opposed to the previous one. So that's the huge difference here. I'm only changing the value of my book value. Okay. So then that's how you journalize it that way, if you want to choose to increase book value. Okay. But you also have the second option, whether you can choose to increase the asset cost. Okay. So in this case, same exact scenario. However, if you choose to not increase book value and I decide to take my $10,000 and increase my asset cost instead, because in this case, right, this $10,000 is going to go to the cost of the asset because I'm replacing the motor. So in this case, I would, instead of doing my book value, I'm going to increase my asset cost. Okay? I'm going to increase it by debiting my machine and by paying for it with cash for $10,000. Okay? Now, what does this do? This actually complicates things just a little more, because in this case, right, when I'm looking at my depreciation table, I've already measured and calculated my depreciation as at 50,000 instead of what it is now. So what you're going to do is you're going to actually end up replacing these numbers and having to redo the whole entire depreciation table once again. So in this case, instead of 50,000, if I'm going to increase it with my journal, right? Therefore, I'm going to increase it to 60,000. And because now the life is extended by 3 extra years, I'm going to also add that 3 extra years to its life. So then now my new depreciation table is going to be 60,000, right? Giving a remaining balance of 5,000 salvage value, but it's going to be in the span of 8 years. So that means I have to recalculate this entire table because now I have brand new numbers. Now in this case, again, with straight line, it's the easier way, right? If you have Excel, you'd be able to pop the answers pretty quickly in this kind of sense. So it's not really backtracking that much. Especially if you use Excel to solve things for you. So in this case, if I'm still doing it by every single month, this is what I need to solve for now. I need to know where I'm at in my 49th month. So if I'm reverting and I'm saying, well, now that I have new numbers, my asset cost is now 60,000 minus my salvage value, which gives me my depreciation basis of 55,000. Now my estimated useful life is over a span of 8 years. So 1 over 8 years gives you 0.2125. So that means every single year I'm going to depreciate, or every single month in this case, I'm going to depreciate my asset at $572.92. So then by the end of my 49th month, I should now accumulate to $28,073.08, which brings my book value to $31.08. 31,926. So in this case, you see this number here, where opposed to the previous one, it was at 13. Or I'm sorry, it was valued at 13,000. Now, when I add that $10,000 in there, I have to recalculate because now my book value is increased to 31,000 instead of 13. So in this case, right, you end up actually getting more benefit out of this because you're recalculating your depreciation. Now, does that mean you have to go back in your books and fix everything? No, 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 no. This is continuing on after this. So then now that you adjusted your books, right? Then you can go ahead and continue on with the next month with the new adjusted numbers. So then you're properly now continuing on and expensing the accumulated depreciation accordingly. Okay, so that's the huge difference here. All right. Any questions here on what it takes to keep your asset and add fixtures or add extra stuff to it to either increase the cost of it, increase the book value, and extend the life of it? This is how you do it. Any questions? Okay. All right. Now the second part here is going to talk about what if I want to exchange my asset for another asset. Okay? This happens all the time. Okay, whether it's trading in an old asset for a newer asset, or if you want to exchange a fixed asset for even another fixed asset, right? So in this case, this happens all the time where you have offers to trade in your used car for a new car and get some value out of it, or buyout value for it, or let's say your company needs a different type of machinery, right? And this machinery, it's being outdated or it's getting old. Yes, you can have what's called a trade-in value to get an exchange for fixed assets. Now, in this case, there's many ways around it. You can do an even exchange, or yes, you can pay more for that option. We call that boot, right? Now, in this case, I didn't talk about boot because that's pretty straightforward. If an asset is going to be more, you obviously are going to pay the difference, which is boot, right? You pay an extra bundle of cash to buy the asset that you want. Now, in this case, I'm going to be looking at a full exchange where it's an even trade here. Now, when exchanging between fixed assets, they must be considered at fair market value, okay? Now, this is where you have to be careful between fair market value versus book value, okay? So let's go ahead and just do the example here, right? In this case, example 3, on January 10, you purchase a small sedan for $35,000 on a car loan, okay? With a down payment of $2,000. Assume that all fees and taxes are included with the price. So again, let's go ahead and record the purchase of this fixed asset, right? So in this case, right, I purchased it as a January 10, right? I purchased the vehicle, I obtained a loan, and I paid, I put a down payment down of $2,000. So in this case, my asset right now is $35,000, okay? We're also going to calculate depreciation because, again, the minute we acquire our fixed asset, especially a vehicle, it depreciates the minute you drive off the parking lot. That's just the rule here. So in this case, we must keep a really close track of our depreciation, especially for a vehicle, okay? And in this case, I'm going to do it by year, just so then it makes it a little easier to calculate. So if I have my asset for $35,000, I'm expected to at least have a salvage value of $5,000, right? Usually, typically, most vehicles have a longer period of time, right? In this case, I'm going to say this asset's going to last me at least 10 years. Okay, a vehicle can go longer than that. Okay, and of course, when you place into service, you bought it as of January 10, and again, with the rule that you start depreciating as soon as you drive off the parking lot is going to become into effect. So in this case, right, I solve for my table here. So if I were to depreciate it for the first year, right, I'm looking at $30,000, 0.10 because it's 1/10 years, which is going to be $3,000 per year. Okay, and therefore, for the first year, if I were to depreciate it, it's going to be for $32,000 at the end of the first year. So the book value is always, always important. Okay, so let's go ahead and say here, well, then what if on the same exact year, at the end of the year, December 28th, right? You decided that, you know what, a sedan is just not going to cut it. I'm going to trade in my car for an actual truck. So in this case, your dealership offers you a trade-in buyout value for your used sedan for a used truck, okay, which still has a fair market value of $30,000. So right now, they have a car for you at the lot saying, hey, if you buy it right now, it's used, it's slightly used, but it's worth $30,000 right now. Okay, that's what the price is right now. Now, of course, you go to the dealership to get an estimate of the fair market value of your sedan. So this is where your fair market value is going to come into play because, again, when you're trading in a car for a car or a fixed asset for anything, you have to get it appraised, okay? You have to get it professionally looked at so they can give you a quote on what your actual car is worth. Because on your books, just because you depreciate it one way, not everybody's going to be depreciating the same way. They don't know how many miles that you drove it. They don't know what you did to the car. They don't know if you even add additions to your car. So they need to have some kind of professional person to take a look at the car and appraise it and tell you, you know what, your car right now, this sedan, since you drove it so many miles, it is actually worth $30,000. Okay, so let's go ahead and record this implied loss for the trade-in for your vehicle. So in this case, right, if you remember, on my books, I think it's worth $32,000, but somebody who looked at it as a professional appraisal told me, no, your car right now at the buyout market value, we'll buy it from you for only $30,000. Okay, that's the trade-in buyout method. Okay, so how do I go ahead and journalize this? Well, you're going to recognize one thing, which is going to be the accumulated depreciation for your asset, which was $3,000. Okay, because we're still December 28, we're still within the year, we're at the end of the year, right? We need to go ahead and put that number in there first. And we also got to put the original price that you purchased your vehicle when you bought it as of January 10, right? We got to look at the historical cost. I originally bought that car for $35,000. Okay. Now I'm gonna, since I'm trading it in, right? I'm crediting my vehicle of my sedan and I'm trading it in for a truck. So therefore, I'm acquiring a truck. The truck is $30,000, right? That's what it told me, right? Now, with the calculations, right, as I've already mentioned before, if my book value says it's $32,000, but the fair market value, if someone's going to buy it out for me, I end up losing $2,000 because due to the market, right? The market's saying, no. Just because you depreciated it and you say it's $32,000, I'll buy it off of you for $30,000. No one's going to ever buy more unless there's some kind of holding value to it. If you add something to it, or maybe you didn't drive it as much, right? They're professional appraisals. for especially those vehicles, right? They can determine what the actual true fair market value is going to be. So in this case, I must record that for this buyout or for this trade-in, I end up losing $2,000 for trading my vehicle for a truck. Okay, and this is 100% common for any household, even anybody that buys a specific car that wants to upgrade their car, they will always end up taking a loss, 100%. Okay, right, and that's how we do for exchanges. Okay, any questions here? Okay. Let's talk about actually abandoning a fixed asset. When you've actually used the asset and you used it all the way to the ground where you're left with just an asset, right? It's reached the end of its it's reached its end of its life and it's not salvageable. You can't do anything about it to improve it. You can't do anything about it. And for some reason, there's no reason to keep it on your books for any reason because it's just trash, right? So what can you do to be able to just abandon it? Now, in this case, most cases, just like what we looked at an example in our exercise, right? We have a laptop. It's already been 8 years old and it still has a holding value of what? $61? Who's going to buy a laptop from you that's 8 years old for $50? Nobody. All right, you can turn it into one of those junkyard scrap places that take any kind of electronics. And they might give you hey, I'll give you money for scrapping your laptop. That's completely fine too. Then that way you basically get a trade-in value for it. But in this case, what if you just want to just get rid of it and get it off your books in general? Okay. So let's go ahead and use that example earlier where we purchased that truck in December, right? Because we traded it in. What if at the end of its life you decide this truck, right, even though it has a holding value of $5,000, right? You drove it to the end of the ground, right? It's already been 10 plus years and you just want to just get rid of it off your books because it costs way too much to maintenance it. The auto repairing for it was just too much that you just want to just get rid of the asset off your books. So this is what you do. You simply go ahead and credit your truck for whatever amount that you bought it for. So in this case, when I did my trade-in value, it's worth $30,000. You're going to take your accumulated depreciation because this is what determines what your book value holds. In this case, it's for $28,000 because I said in this case that my ending value or my salvage value for my truck should be $2,000. So then at the end of the day, when I scrap it off and I abandon it into a junkyard, right? I'm gonna be taking a $2,000 loss onto my company, and that's it. There's no money I'm getting out of it. There's nothing, I'm not trading it for anything else. I'm just abandoning it and taking it off my books. And this is how you do it. You simply just debit your loss, you debit the accumulated depreciation, and you just get rid of and credit your fixed asset. Pretty straightforward. Okay? Right? So that was the first section there. Now let's talk about what goodwill and impairment is. So in this case, your little lecture notes talk very, very briefly about impairment, but it does not talk about where goodwill comes from. And what goodwill comes from is actually what we're going to talk about when we actually dive into the fictitious business. So where does goodwill actually come from? Goodwill is actually known for when you acquire a business, okay? Goodwill is more or less going to be when you buy out another business, right, it has some kind of valuable assets that when you do end up liquidating it, it actually ends up being a higher value than what you originally purchased it for. Okay, so for this example, right here, goodwill is going to be determined by the purchasing price of acquiring another business at its fair market value. And again, we're going to be looking at what's called the net fair market net of assets, okay, which is going to be your total assets minus your liabilities, okay? And of course, if there is an excess, then that becomes goodwill. What does all this stuff mean? Well, let's just go ahead and take a look at an example so it's kind of a little more clearer to you, okay? So in this case, company ABC wants to purchase company XYZ. So, of course, before even looking at purchasing a business, this is what the business provided you. This is what they recorded on their books. This is their book value for everything that they have currently on in their books. So again, for assets, right? They have cash valued at $25,000. Okay? They have accounts receivable for 36,000. And then of course they have inventory that's on their books currently valued at $15,000, and they have fixed assets, so which includes, machinery, whatever, that's currently valued at $56,000. Okay, so giving a total of $132,000 worth of assets. And the liabilities, right, they still have loans to pay off. So they have $50,000 worth of loans, and of course equity is going to be the asset minus the liabilities, which is going to be $82,000. So in this case, this is their books that they said that this is what you are going to be acquiring. Okay. Now, of course, what you have to do is this. You're not going to be keeping all of this stuff that the previous company had. So what you need to do here is you do need to go seek it to an actual professional to go through an actual appraisal to determine the fair market of the assets. Okay? So in this case, right, when we go through that, now this is the company XYZ's balance sheet, but now we're actually looking at the fair market value, okay? Now, of course, fair market value for cash, right? Cash is going to stay the same because it doesn't increase in value, all right? Because there's no purpose that it would increase in value. Usually, cash is going to stay the same. Same thing with accounts receivable. However, inventory, right? On their books, they say that it costs them $15,000, right? But if I go ahead and go around and sell those inventory, it's going to increase by $40,000. So in this case, the value of my inventory, the fair market value of it when I sell the product that means it's going to be worth $40,000 opposed to $15,000, right? Because again, when we talk about inventory, right, we buy it at cost, but when we sell it, we gain a profit. So in this case, if a company ABC acquires this company, they can sell off the inventory for a higher value. Okay? Same thing with fixed assets. They can sell off their fixed assets, right? In this case, on their books, they say it's $56,000. In this case, if I'm going to go out and sell those fixed assets, it's going to be worth $100,000. Okay? And then they've also found out that patents. Now, again, on a book value on a person or a company's balance sheet, right? You're always going to treat intangible assets as holding zero value, right? Because they expire at the end of a given time period, right? So on the previous one, it holds no value because it expired. It will eventually expire, especially when transferring titles from one company to another company. Now, in this case, when we went through the appraisal, they said that if you purchase this company and you renew the patent on here, this patent is valued at $10,000. So in here, we see that a lot of the fair market value, if we acquire this business, right? What can I do to gain more money? Or in this case, what happens if I liquidate my assets? Boom. These are the fair market values of it. And because I'm looking at the net assets, right, which is your total assets minus liabilities, right? Obviously, loans are going to be the same because if you owe money, therefore it's going to stay the same, okay? That's assuming when you acquire the business, you're going to pay the loan right away. I got to subtract that out. So now my total net is going to be now 161,000, where opposed to my book value was only 132. Okay, so it jumped up, it increased by a lot. Okay, and then now I have to figure out, well, how much is going to be my goodwill? In this case, since I looked at the fair market value of all the assets, I went ahead and said, company ABC said, I'll purchase the business XYZ for $200,000. Okay? So if I purchased it for $200,000, this is what's going to happen. I'm going to acquire all the business's assets and including liabilities. Okay? So that's going to be all the things at fair market value. Okay? Not at book value. I do it at fair market value. Okay? And then what I'm going to do here is I'm going to record, obviously, the amount of money that I paid. If I pay $200,000, right? Now I need to calculate what the difference is in order to solve for my amount of goodwill that I will be acquiring. So the goodwill is actually going to be determined as the difference between the purchase price and the fair market value of net assets. So in this case, right, from my previous slide, my fair value of my net assets is currently 161. Okay? And if I purchase the whole entire company at 200,000, the difference between 200,000 and 161 is going to give you 39,000. And that's going to be considered to be goodwill. Okay? So when we talk about goodwill, that means we're acquiring another business, right? We're acquiring their brand. We're acquiring their patents, their copyrights. We're acquiring their business. And when we, again, purchase at a higher price and we value our assets, the difference between it is going to produce me goodwill. So again, I'm buying the company name. I'm buying this patent right here, right? Because patents are very unique to companies because this is their idea and we're buying it out. Okay? So that's why we gain a value of $39,000. Okay? And that is how goodwill is generated. Okay? Any questions?
No.
Okay. So then, what is impairment? Now, in your reading, they don't even go into detail about impairment. It's just like maybe like 5 sentences about impairment. Every company that has some kind of fixed asset will actually undergo through impairment. Now, again, impairment is going to be something that is more or less for intangible assets, okay, not fixed assets, excuse me. Intangible assets are going to have impairments in them. Okay, what does it mean to have impairments? Meaning it can lose its value at any given time, at any given moment. There's no real determining factor of when it's going to happen or why it happens, okay? Because it's intangible. You can't physically touch it, so sometimes you can't even put a time limit on it. So that is exactly why impairment only happens for intangible assets, especially if there's an indefinite time or it has a short life or a long life intangible asset. Okay? Um, so that's what impairment is. And every company must go through it to adjust their intangible assets accordingly, right? So they say here that Goodwill, right? Usually, if you're buying a company's name and you're buying the patent and you're buying, the brand of the company, that should actually have it should have no end to its life because it's permanent. It's going to be indefinite. So therefore, there is no need to have to amortize it over its time. But in reality, that's not true, right? You can't be saying, I'm going to hold my brand name for the rest of my life. No. Eventually, people forget about the brand name. The brand name becomes obsolete. The brand name becomes, reinvented always, right? Brand names die out. So, what is the best way to keep, having to either rebuild the brand up or let that brand die out? And in this case, 100% because most likely when you obtain other businesses, that business that you obtain slowly dies out, and it merges into your the bigger company that who bought it out. So in this case, in reality, Goodwill will eventually just lose its value over time. And we would have to just amortize it regardless. Now, what gives us the right to be able to amortize it? You must go through an impairment test. Okay? Or else, by the rules of GAAP and FASB, they say that no, you shouldn't amortize Goodwill because of its indefinite life. But we know that's not true. We know that it's not true because eventually Goodwill will eventually die out along with the company, the brand name, anything that's attached to the Goodwill will eventually die out. And that's why they say, well, amortization is going to be the best way so then you can match your expenses with your revenues, right? So in this case, you have to have a reason to be able to do that, and that's only if you must test Goodwill to see if it holds its carrying value. So if when the day that you acquired it or the day that you purchased it, that's the holding value or the carrying value, right? Then we're going to compare it to the actual fair market value. And if it drops or falls below, then that's how you know that your Goodwill is at risk or it's going to become impaired because it's losing its value over time. So how do we do this? Now again, rule of thumb here is that Goodwill should be tested for impairment every year. Just like all other intangible assets, not fixed. All intangible assets, right? Especially patents, licenses, copyrights, right? You want to make sure those things are still upholding its term or its life, okay? So let's go ahead and take a look at what impairment does, okay? So let's look at step 1. How do you determine impairment? Well, just like from the previous example, right? When we acquired the business, when company ABC acquired company XYZ, right? We acquired it for $200,000, and we know that the Goodwill came out to be $39,000. Now, let's say a year later, you're revaluing its assets once again, right? So you're going to go through the process of going to figure out once again what is now my current fair market value of my net assets. So in this case, when you got it reappraised and revalued at it, now a year later, company XYZ's assets or fair market net assets has now dropped to 175. Okay? Before, it was valued a lot higher, right? It was valued at what was it? I think it was valued, I don't remember, but it was valued something. It was very valued then. And that's why ABC company decided to purchase it for $200,000. So this is how we're going to do it. So how are we going to determine whether Goodwill has been impaired or not? So we got to determine the implied Goodwill. What does that mean? So in this case, we're going to be taking a look at the fair market value of what the company XYZ exists currently. So in this case, it's telling me that the asset are now worth 175,000, right? Then you're going to counter against it by the carrying value of goodwill, which is going to be the purchase price of the assets, or the purchase price of the company that you acquired, minus goodwill, because you can't compare goodwill with if goodwill's included. So in this case, I'm going to take my value of my 200,000 minus my 39,000, which gave me the 161, right? That was my previous carrying value for XYZ company. So then now, since I have to less it, we're going to determine that the implied value of goodwill has now 14,000, right? You're going to find the difference between the 175 and the 161, okay? And once you figure this number out, then step 2 is you're now going to calculate the actual whether goodwill has been implied or not, or I'm sorry, has been impaired or not, okay? So I'm going to take my carrying value of goodwill that I had from the very beginning, which in this case, right, the carrying value is what you originally purchased it for and what you originally recorded it in your books as. So in this case, I recorded it at 39,000, okay? Because my implied goodwill was calculated to be only 14,000, the difference between that is going to determine whether there's a loss or a gain on the impairment. In this case, I got a low number of 25,000. Okay, so the difference between it gave me a lower number. It gave me 25,000 because in this case, I have to subtract it out. And in this case, I end up getting a loss on impairment. So therefore, that means this tells me here, my company of XYZ, all of its assets, all of its worth is going to decrease in value over time. So that's what this tells you here. When you have a loss and impairment, it tells you that goodwill, the brand name, the patent, the copyright, is going to lose its value over time. Now, in this case, you have two ways that you can, record it. You can either amortize it slowly through its rest of its life, or you can simply just swap it out and say, well, if my carrying value is going to be 25,000, then I'm just going to head and just write off that 14,000. Okay? Now, when you do, and if you do swap out, or in this case, replace the value, if this loss on impairment is going to become your carrying value, then you need to make sure that once you've journalized that, the loss due to impairment, then that means you can never undo it. So let's say next time around you do the test again and it actually gained a value instead of lose a value, you cannot do anything there. That means because you already changed the value of it. You cannot, therefore it will that way, if you do change the value of it, you cannot undo it. So you want to be very careful on the choices that you want to do. But this one tells me, well, yes, eventually goodwill will lose its value over time. So that gives me the guarantee saying, okay, that means I can amortize my goodwill. Or I could just take the carrying value and take the applied value and go ahead and take the difference and just replace my goodwill with that number instead and adjust it accordingly. Those are my two options I had there, okay? And that is it for this chapter here. Now, some of my students, they do ask, well, what happens when you have to get rid of your assets? This is what you have to do, okay? And where does goodwill come from? It comes from acquiring a business. So again, I'm not going to test you on anything that you learned here because this is not going to be on the exam because you're already have to be calculating depreciation for me. So anything that's here, it's just extra information for you to carry on in the future. When you do bookkeep for a company and let's say you come across where they tell you to sell the fixed assets, this is what you do. And this is how you do it. Okay? Any questions in regards to the last part of chapter 11?